Hey everyone, me Kevin here. Is Cathie Wood wrong about inflation? In this video, we'll discuss and we'll talk about the three types of inflation camps that exist. Now, you might think, wait a minute, I thought there were only two. I thought there was either the inflation camp or the non-inflation camp. Well, it goes a little bit more deep, and by the end of the video, I want to know which camp you're in, because there are three and you got to know what they are. And it's helpful to know, is Cathie right about what she says? But first, I want to just quickly mention that this video is brought to you by Masterworks.io. They've got a special link in the description below that lets you skip a wait list that they have, so check that out. We'll talk more about them in a bit, and check out the Black Friday sale for the programs on building your wealth, linked down below. Okay, let's get right into Cathie Wood without any other delay. Check this out. Cathie Wood responds to Jack Dorsey from Twitter and Square when Jack Dorsey says hyperinflation is going to change everything. It's happening. Now, in this video, we're going to really pick apart Cathie Wood's argument here. She says that, hey, look, in 2008 and 2009, when the Federal Reserve started printing money, she thought that inflation was going to take off. But she says she was wrong, because the velocity of money, or the rate at which money turns over, declined, taking away that inflationary sting. And intuitively, that seems right. It would seem that if I had $5, and I spent it on a hot dog, and that hot dog vendor spent it, and then whoever received that money spent it, and so on and so forth, and that chain happened 10 times, then we would create $50 of value. But if that chain only happened 5 times, we would create $25 of value, and it would make sense that the 10 times version would create more inflation, right? So it kind of makes sense when Cathie Wood says, oh, well, yeah, the velocity of money's down. There's not going to be inflation. We're good. But wait a minute. Is that historically accurate? And is that actually how the velocity of money is calculated? Well, let's answer exactly that right now. So the easiest way to understand the velocity of money is not trying to overcomplicate it. I think most of the time when we hear this phrase, we're like, this is ridiculous. I cannot pay attention to this. I do not want to pay attention to this. This is insanity. But it's really not that difficult, because take a look at this. There are 3 things that you got to know, and they're really, really easy. Number 1, let's throw down the size of the economy measured in how much money we spend. Okay, about $21 trillion per year. Roughly. We're going to do rough estimates to show you an example here. Okay, this is known as the GDP, the gross domestic product. You don't even really have to know that. All you have to know is, okay, size of the economy measured by the sum of all the things that are spent, $21 trillion. Got it. Sounds good. Okay, cool. Now, let's divide that by how much money exists. Well, we could use something complicated like the M2 money supply, or different measures of money supply, like how much money is in savings account, checkings accounts, retirement account, blah, 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 blah. Or you could just go with the example and go, there's probably somewhere around $7 trillion floating around out there. Okay, cool. Got it. Got it. All right, well, now if I divide these two, the size of the economy, by roughly how much money is floating around out there, which again could be approximated by M2 or M3, it doesn't matter. We're keeping this simple here. Then you're going to get a velocity of money of 3. This means a $21 trillion economy was created by $7 trillion circulating 3 times each. Now, that doesn't actually mean that every dollar I spent circulated in the economy 3 times. Like, you could have spent $1 and it could have circulated 30 times. And I could have spent $1 and it could have circulated 1 time. It's just a big, fat, boring average. And so when you look at the velocity of money chart, and people are like, oh my gosh, the velocity of money is going down. And when the velocity of money goes down, that means we're probably not going to have inflation, right? As much as I'd like to agree with that simplistic argument, it might be historically wrong. And we're going to talk about that history in a moment. And here's where you could start getting a little sussed out by Cathie's argument. You ready to get sussed out? Let's go back to this math for a moment. Let's say I print $3 trillion tomorrow. Like I'm Jay Powell and I just got this magic money printer and I print $3 trillion more dollars, and we've got a similarly sized economy. Does that all of a sudden mean there's no inflation? Well, let's do the math. Take a look at this. Okay, we are now going to say that there are $10 trillion of money supply, which 21, the size of the economy divided by 10, means money supply is actually money velocity is actually 2.1. Wait a minute. The more money was printed, the more the velocity of money went down instantly. It's kind of like Jerome Powell came in with a big punch bowl And it's like, hey, you were using a small punch bowl earlier, which meant when you took punch out of it, you were taking a bigger percentage of it. Now you got a big punch bowl and you're taking out less of a percentage. We need your money to circulate less, in other words, right? We need your juice to affect less of the big pie. Because we just got you a bigger punch bowl and everybody likes the party. So we got to keep the party going, more punch. Okay, don't worry so much about that. The point is, wait a minute. If we print money, automatically the velocity of money goes down. All right, well, now take a look at this. Here's the United States outstanding debt. Look at it. Last 20 years from 2020 right here, whoop, straight up. And the velocity of money, the last 20 years, whoop, straight down. Oh my gosh, it literally makes sense. You print more money, the velocity of money goes down. It's that freaking simple. But wait a minute. What does that tell us about inflation? Well, inflation's nowhere in this equation. Bingo. Inflation is actually not in the equation of the velocity of money. Inflation might literally have nothing to do with the velocity of money. But wait a minute. We should fact check this because intuitively, if my money circulates less, that would imply less inflation. Remember that hot dog example we did? Yeah. Well, what does history tell us? And if the velocity of money doesn't affect inflation, then what actually does? Is Cathie right? Is she wrong? What's going on? Well, I'm going to answer that right after I quickly shout out Masterworks.io. Special link down below that lets you skip the waitlist. And Masterworks wants you to know, folks, look, they let you access an asset class that has low correlation to the market, but has technically outpaced the S&P 500 by 174% from 1995 to 2020, has seen almost double the appreciation rate of real estate, gold, and 90% of cryptocurrencies during the same period, and according to Citibank has, like I said, the lowest correlation to the market, making this a neat asset class for diversification. It's also grown over 2,700% in the last 20 years with little signs of slowing down. And it's even gone so far that the Wall Street Journal is now calling art among one of the hottest markets on earth. And see, Masterworks makes your life easy if you want to invest in art because they essentially securitize the art so that way you don't have to be in the top 1%, but they bundle the art together as a pie, slice and dice it up for you, allow you to invest in a slice of that artwork, and boom, you're now investing in a slice of potentially multi-billions of dollars of artwork. And the cool thing is, if Masterworks sells the entire pie, you get your share, which hopefully is very profitable for you. If you want to sell your shares beforehand, they even have a secondary market for you to do that. And so I encourage you to learn more about Masterworks.io by going to the link down below. Skip that waitlist, use that link down below, and check out Masterworks. Thanks for sponsoring this video. Okay, now, what does history tell us about the velocity of money? Because right now, you know, this so far, it's kind of like, wait a minute. Cathie Wood says velocity is going down, but when we do the math, velocity doesn't seem to have anything to do with inflation. But we should fact check this. We should see if there's a pattern in history. Okay, we can do that. Let's go to history. So let's start with the 1970s. We had extremely high inflation in the 1970s. Go to CPI. Look at this. 1970, starting in 1973, massive peaks of inflation, 10, 11%. Very, very volatile here. You go down to 6%, then you go all the way up to 14, 15%, and you come crashing back down. So look for between 1973 and about 1983. This was CPI. What did the velocity of money do between 1973 and 1983, right here in this period? Very little. Very, very, very little movement. So you had mega high inflation, the highest inflation that you've ever seen, and the velocity of money didn't skyrocket, which if Cathie Wood is right that we're not going to see inflation because the velocity of money is going down, then it would make sense that if we're seeing hyperinflation, the velocity of money would be going up. But we didn't see that here. We did see the velocity of money have like this giant tumor of an explosion over here in the 90s. But what did inflation do in the 90s? If Cathie Wood is right, then as the velocity of money goes up, we should see more inflation, right? Well, what happened in the 90s? Ah, crap. Inflation went down. Literally wrong. Like wrong. No correlation in the 70s between the velocity of money and inflation. No correlation in the 90s between the velocity of money and inflation. And what about the next period of 2010 to 2020? Well, the velocity of money was kind of stable I'd say relatively flat. You could probably draw a pretty relatively flat line through here with the exception of maybe 2015 here. So pretty flat. And what happened to the velocity of money? Was the velocity of money flat? No, the velocity of money plummeted, which if the velocity of money plummeted, we should have seen inflation plummet, but it really didn't. It kind of stayed consistent and consistently low, like probably somewhere around 1.75%. So you've kind of seen it all here. You've seen that the math doesn't agree with Cathie Wood, that the velocity of money that we look at, the charts of velocity of money, don't seem to have anything to do with inflation. The 1970s, the 1990s, and the 2010s indicate that the velocity of money has nothing to do with inflation. So using the charts for the velocity of money to try to understand, like, are we going to see inflation? Probably a really bad idea because they're broken. That doesn't work. Now, again, intuitively, it makes sense. If I have more money and my money's going to circulate in the economy more, then it would make sense that prices would go up, right? Because I could create more demand. But that would be measured in GDP growth. See, remember when we were selling hot dogs? If the hot dog market creates $25 of power, that goes into the GDP equation, which means we have a bigger numerator in that GDP equation, which take a look at how that could potentially work. You jump back over here, and let's say the velocity of money, which really, let's just get rid of that because velocity of money doesn't seem to have anything to do with inflation. Let's go back to the numbers that we originally had, which was $7 billion or $7 trillion circulating, velocity of money of 3, and a $21 trillion economy. Well, let's say my money went a lot further, and instead, all of a sudden, we had a $28 trillion economy. Okay, well, the economy grew, and in this case, the velocity of money went up. Yeah, that's true. But did that mean we had inflation? Or did that just mean the economy grew? Well, in this case, we could just compare the United States GDP to what inflation has done. And if we look at the gross domestic product for the United States, we get this chart right here. This is the GDP, which you really only see falls during a recession, which makes sense. People are spending less money during a recession. Imagine that. Otherwise, it's like straight up. And inflation is literally anything but correlated to GDP. Like, it don't care. So far, every possible way I can look at measures of how GDP or the velocity of money is related to GDP, Cathie Wood's argument fails. It fails every single time. And again, intuitively, it seems like it should make sense. But maybe when people spend more money, GDP just goes up. Which Cathie Wood is expecting GDP to go up. But that doesn't necessarily mean we're going to have a lot of inflation or no inflation or deflation. There's no correlation that I can find. So instead, it seems like inflation is a little bit harder to predict. Inflation really comes down to supply and demand, and that's why we have such crazy debates. In fact, right now, there are a lot of fears that a COVID resurgence in Europe could spill over to America during the winter, leading to new lockdowns and new restrictions potentially on manufacturing, which means we might worsen supply chain constraints. And even if demand is constant, supply goes down. Well, if supply goes down because of manufacturing constraints or shipping constraints again, well, then simple Econ 101 says supply goes down, demand stays constant, then price has to go up. Price goes up if supply goes down, but demand is constant. The only way price would stay stable is if supply fell, but then demand also fell. But we've seen that's not how it works. So, bottom line, and then we're going to talk about the 3 different paths we could actually see with inflation. Inflation seems to have nothing to do with the velocity of money, at least from the research that we could do here using the charts. So if you're trying to track what inflation is doing, ignore the velocity of money. Instead, focus on what's creating prices to go up. And do you think that the reason prices are going up is going to be a consistent or sort of persistent reason that inflation goes up? That's really, really important because look, prices, remember this, always remember this. Prices of this Monster energy drink right here could go from $1 to $2. And then we had 100% inflation. Oh my gosh, clickbait, 100% inflation. Wah! Prices doubled, it's insane. Okay, what then happened the next year? It went to 1.99. Minus 1%. Oh my gosh, deflation, right? Like you would have to have prices go up every year, year after year after year after year after year, to have persistent inflation. And so you got to ask yourself, do you think that prices are going to go up year after year after year after year? That could be for rents, that could be for food, that could be for cars, that could be for chips, that could be for computers. You might say yes, and that's fine. If that's what you believe, then you are going to be in camp inflation, which basically says that unless the Federal Reserve raises rates to stop people from spending cheap, easy money, then we're going to keep inflating because people are just going to keep buying. And if anything, they're going to keep buying more on purpose until rates go up because money's just so cheap. Possible. That's camp 1, camp inflation. Camp 2 is the deflationary boom camp, and this is where Cathie goes. See, Cathie believes that, no. It's going to be easier to put this monster together and ship it to you in the future. We're going to have robots delivering this to your door in the future. It's going to be cheaper. It's kind of like a 48-inch HD TV in HGTV, too much real estate. It's like a 48-inch TV in 2008 costing $2,000, and today you buy it on Amazon for $300, right? That's deflation. That's 15% of the cost of what it used to be. The other thing Cathie Wood says is that companies that don't learn how to adopt are probably going to fail, become obsolete, and to service their debt, they're going to have to cut prices. And she thinks when this happens, we're going to have productivity go up at the surviving companies, and we're going to actually see GDP go up during a deflationary time. So camp 1 is we're going to have lots of inflation, and we're screwed unless the Fed raises rates. Cathie says inflation's going to go down. We're going to see deflation over time thanks to innovation and older companies going away. But we're going to boom because of that. We're going to have an economic mega rally because we're going to have the most efficient companies in the world potentially. We're going to be spending money without concerns about inflation. We could have easy money policies without being concerned about inflation, and we're going to boom. Or you could be in Camp Ray Dalio, and this is camp number 3, and this is inflation's not going to last forever. It's going to go down, but when inflation goes down and turns into deflation, people are going to be motivated not to spend their money, which is going to shrink GDP, lead to fear, and people hoarding money, waiting for lower prices, creating a deflationary spiral. It's kind of like, hey, if the car is $15,000 today, and next year it's $12,500, and the year after that it's $8,000, I'll just wait to buy a car. Unless obviously you have a necessity, but if you have the choice, if it's discretionary, you have the choice, which for a lot of people, buying a new car is discretionary. You just buy a new car because you freaking want one. That's the American way, right? But you might put that off for deflationary purposes. Well, there you go. Now you might be in a situation where we have a deflationary bust because our economy starts shrinking. When our economy, our GDP shrinks, we fall into recession. When we fall into recession, the stock market sells off and you got problems. So, what did we learn in this video? Well, I think we learned a few things. Number 1, the velocity of money is not as easy as we think it is. We can't just look at the chart of the velocity of money and go, that's it, velocity of money is going down, we're good. You also can't look at the chart of the velocity of money and go, as soon as this goes up, we're screwed, we're going to go into hyperinflation. Honestly, the velocity of money should just not come up in discussions anymore when we talk about inflation. I'm going to make that a rule for myself. No more discussions about the velocity of money because it's A, too difficult to measure. B, if the velocity of money goes up, GDP goes up, which doesn't necessarily mean we're inflating. GDP is supposed to go up over time. We're supposed to be more productive with our resources, right? And be able to have a larger expanding economy and be able to make more money and spend more money. That's the point over time, if you believe in the growth of America, right? But we also learned that there are 3 inflationary camps. That one is we're going to have an inflationary nightmare, and unless the Fed raises rates, we're going to have hyperinflation, we're going to have problems. Or maybe we won't go to the extent of hyperinflation, but we're going to have inflation for a while. The other camp is a deflationary boom. Don't worry about inflation. Prices are going to come down, and we're just going to keep booming. Or we're going to have a crash because we're going to have deflation. I want to know from you, which camp are you in, and what do you think? Thanks so much for watching this video. Check out Masterworks, a link down below, and those programs on building your wealth. Thanks so much for watching, and until next time.